Dear friends, my name is JP Sinha and I'm again here for the second session of Theory and Practice of Personal Finance. Today's session is about how to get your asset allocation right. But first of all, I'm very thankful to all of you for encouraging me in this journey. So without much ado, let me begin the session. I have divided this session into 3 steps which will help us in arriving at the right asset allocation. The first one being, why should we worry about the asset allocation in the first place? I am sure you all have heard multiple times that you should not put all your eggs in one basket. The reason is very simple. When you are carrying it, there is a possibility, howsoever small that chance may be, but still there is a possibility that the basket may accidentally fall and you are left with all the broken eggs. This same principle applies to money and investments as well. We have seen AAA rated companies defaulting. We have seen cooperative bank customers losing their deposits. Blue chip stocks losing 90% value. And all these leave you gasping for breath. Chance, as underlined in the slide, is an important word here. Since the outcome may vary across many results, and any such result is possible at the end, which we will know only when the journey is complete. So when you have all your eggs in one basket, there are two possible outcomes, right? It may be transported safely or not. So either your entire 100 eggs are safe or you get 0 eggs. Obviously, one is a happy and another is a sad outcome. So now when we follow the old saying of do not put all your eggs in one basket, let us distribute them in 4 different baskets. Now with 4 different baskets, obviously the outcomes are also now many. There could be all the baskets are safe, 3 are safe, 2 could be safe, 1 only can be safe, or all 4 falling irrespective of taking you all the necessary precautions. But now instead of just 2 outcomes of 0 or 100, we have now 5 outcomes of 0, 25, 50, 75 or 100. This simple exercise, what has happened, it has enhanced possibility of your non-zero outcome from the first 1 in 2, that is 50%, to now 4 of 5, that is 80%. So what do we learn? Diversification has helped us in increasing our probable outcome. Each possible path has its own probability, volatility, and the correlation between the different paths. Now, selecting these 4 paths has helped us in increasing our probable outcome. This is what exactly happens in finance and with your assets. With this, I will move to the second step. So we conclude saying asset allocation does matter and it does help you to reduce your risk and get an optimal balance of risk and reward for your portfolio. And this is our next step. How shall we achieve an optimal return for a particular risk, or let's say highest return for a particular risk, or lowest risk for a particular return? I'm sure you must have heard that risk and reward go hand in hand. Higher the risk, higher is the reward. So if you keep your money in bank saving account, it has one of the lowest risk, but then return is also low and sometimes even lower than the inflation. On the other hand, everyone will keep telling you that invest in equity. It is very rewarding. But let me remind you, it comes with its own set of risk. There is no free lunch. In this slide, I have put some of the asset class and their risks. You would observe that as the return goes up, so as the risk also rises. Let me reiterate, there is no right or wrong risk. It all depends on your own risk profile and your risk appetite, the ability to handle risks. There are many investors who keep all their savings in banks' fixed deposits. while there are other set of investors who invest in high risk assets and often get rewarded. My only submission is that one should invest in high risk assets only when they understand it fully well and can take suitable mitigating steps. Or the best is to leave your money to be managed by the experts. As I am saying, keep saying, each investment instrument and the asset class comes with its own set of risks, which is nothing but a combination of A, risk which is intrinsic to the asset, and B, the market risk under which it exists. To give you an analogy, consider you are going from Mumbai to Delhi by road. Your journey is going to be a pleasure or pain depending on two broad items. A, the road conditions, weather or the government restrictions along the way, and B, your own mode of travel, which could be car, bus, bicycle or even your feet. So investment journey is also same. Point A is nothing but the generic risk, which is also known as systematic risk, and point B is your own intrinsic risk known as beta. So the question is, how do we arrive at the optimal balance? This graph explains the optimal balance in the most simplistic term. If I have to put all my money in risk-free assets, then my return is denoted as RF with zero risk. And as the risk increases, my return also increases, which is shown as the gray straight line, which we call in finance capital market line. Then I have various combinations, rather innumerable combinations of assets in my portfolio, and accordingly their expected return will be all over the place in the graph. If you look logically, all such portfolios will be on the right side of the capital market line, else the gray line itself will shift to the left. So this becomes the boundary. The green line is our main focus of this graph. All portfolios falling on this green line, which is called the efficient frontier, and as the name suggests, are indifferent when it comes to risk-reward combinations. The green dot of 100% bonds is same rewarding per unit of risk as the orange dot on the capital market line and also the red dot of 100% stocks portfolio. As an investor, now we have to opt a portfolio which suits our own risk profile. All the other grey dots are obviously suboptimal because there is another portfolio which either has lower risk for the same return or higher return for the same risk. So it is very logical to question why not invest on the security market line itself. You must have heard about diminishing marginal return of risk. This is why the security line is curved, because as we keep on diversifying, the incremental return is diminishing. So now you know that once you know risk profile better, you are closer to finding a suitable optimal portfolio for yourself. Let us now move to the last step of this session. At the end of this second session, now you are familiar with A, your needs and goals, B, your own risk profile, and C, risk of various asset class and their own dynamics. These are the only requirement to get your asset allocation right. So how should you allocate your own assets, or rather financial assets? There are some combinations which I have given here. For beginners, it may help a lot. For others, they are anyway experiencing their own portfolio. You may select to pause here and read them carefully. So finally, to recapitulate, I will repeat the same three things. It is the disciplined approach towards these basics that makes you very disciplined in your own investment journey. However, we do falter, we do make mistakes, and it is therefore very important to come back on track very quickly. So with this, we come to end the session 2 of this 4-session series. In the next session, we'll be looking at the practical approach of identifying the various products within each asset class, the execution and monitoring of your portfolio. I once again will say that it is not enough to thank all of you for encouraging me to continue with this journey and make it exciting, make it very useful for all of you. So till the next session, stay safe, stay blessed, and thank you.